Welcome to the Giliberto Levy High Yield Investor Conference, also known as the GL2. It's really hard for Michael and me to think about. This is our 9th time, and I remember distinctly our first time we were in New York in one of the tall buildings overlooking Times Square, I think, and we were at a really small conference room table. And let's just say that it wasn't at all crowded. We had plenty of room for more people. Interestingly, at that moment, all of the people that attended were U.S. investors. This year, we have a lot of new participants. And as a result, we have a lot of first-timers. In fact, the crowd this year is more than double what it was last year. And interestingly, although we do have obviously quite a few U.S. investors, we also have a real attendance from Pacific Rim, from the Middle East, and from Europe. So due to the large number of investors that are new, we're going to ask you to tolerate while I go through a few basics. And if you're a veteran, please bear with us. The slide you see is what we're going to cover today. The general welcome, an overview of the GL2. Michael will drive through performance, give you some context and background to the research results, some new research updates, and then concluding remarks. On a housekeeping note, we're putting everybody on mute. So that doesn't mean you can't ask questions. You're just on mute. Please note that all slides are copyright. And please call or email us if you would like to. We're generally very willing to do that, but we do want to give you permission to use copyrighted material. Question and answers. There is no dedicated question and answer time, just like there wasn't last year. You can ask questions anytime. There is a Q&A button, and if you ask a question, we will ask it anonymously. Now, that's a little weird because I can't imagine that anybody in a commercial real estate group is shy, but it does seem like that's the case. So if you have a question, ask it, we'll answer it. Last year we had more questions than we had time. So what we will do is we will get around to answering the questions after the session, and either by email or by phone. All right. The GL2, the High Yield Real Estate Debt Index, Julia. This is, we think, the index for measuring high yield CRE debt. We measure total return and its components, and we get the data directly from lenders. This question comes up all the time. Do you get it from third parties? Is there any scraping? The answer is no. So if you're a member of the GL2, you give us the data directly. It is consistent with fixed income indexes, including the GL1. We'll talk about that in a minute. Stock indexes, real estate indexes like the NPI and the IPD. And we've designed it for really 3 groups: portfolio managers, capital allocators, and consultants. And we have a much expanded group of consultants with us today. This is a total return mark-to-market index. And we have the data is produced quarterly, but we get data monthly. So it's a mortgage index or a real estate index. So we do have monthly data, even though we get the data quarterly. The first quarter 2025 is out. Obviously, the second quarter is not. We are GIPS compliant. So if that's a worry for you, don't worry about it. And our approach, excuse me, our approach is the same or whether it's a single investment, a portfolio, or the entire index. Go to the next slide. The income return components are pretty simple. They're exactly what you would expect. Cash interest received plus accrued and capitalized, other income, which is mainly fees, gross income is the total, and then we have expenses that are charged to the transaction. Less interest expense, nets for leverage positions equals the net income, which is the income return component of the total return. Between last year and this year, we've hosted I don't know how many Zoom and other calls. And one of the questions that comes up quite a bit is, what are the two most requested slides? Or what are your most requested slides? So drum roll, please. Here are the two most requested GL2 slides. This is the subordinate debt slide. And I think what's interesting there is look at the colors. We're up and down the X and Y axis, as you can see. The kind of orangey things are bridge. The blue are stabilized, and the gray are value add. And I look at a couple things. One, I look on the right side where it says the average attachment point, and that's 51%. The average detachment point is 68%. Now, actually, from my point of view, that's lower than I would have thought it would have been when we started. And it's a tad lower than it was last year on the upper attachment point. I don't think it's substantial. I don't think it's meaningful. But what all the dots do mean to us, which is meaningful to you, is that we can give you a customized benchmark. In other words, if you decide that 51 to 68, that's just not who you are, and that's fine. You know, that your index or your needs are for transactions that are maybe 55 to 72%. We'll give you a customized benchmark for that. So this is a scatter diagram that shows you how that looks, and it also shows you why we can do that. All right. Our number one most requested slide is we now have 15 years of data. That's just hard for me to believe. I can remember when I thought if we got 5 months, it would be pretty good. And we can really show you how returns go across across the market. For example, the GL1 is right there. That's the granddaddy of our slides. That's the first index we used. We now have more than $1 trillion, and that's trillion with a T. We've been tracking this since 1983, although, excuse me, 1993, but we have data back to 1972. And we've gone through some 86,000 loans. But this is the kind of index you'd use if you wanted to be a general account for an insurance company or a pension fund. These are fixed rate, US only, first mortgages only. But back right after the GFC, we started to get calls, reverse inquiries from you guys. And what you said is, look, I really want to do high yield. Do you have an index for that? We were thinking we'd use the GL1 and then add 50 to 100 basis points, and that would be a good high yield index. What do you think? And I think Michael and I thought about that and said, we love the idea. We have no idea whether returns are right. And no, you can't use our name because we are facts-based, not opinion-based. So with that, we started the GL2. As we said, we now have 15 years of data for that, and we're showing you the first quarter. I don't find personally the first quarter of the first year too interesting. But I do look at the 3, 5, 10, and what you would see is that if we had used the numbers that were given us of 50 to 100 basis points, we'd be way off. So for 10 years, the difference between the GL1 and the GL2 is almost 500 basis points. But if you want to compare to other indices, we can do that as well. So if, for example, we use um, investment grade CMBS, if that's your proxy and you want to say, how does the GL2 compare? Okay, we've got it. Same numbers. Again, pretty much across the 3, 5, and 10 year, the GL2 crushed the investment grade returns. But I know many of you are not just in real estate, you're in corporates as well. And we can help you with that as well. So again, this is the corporate intermediate high yield. This is from Bloomberg. All these numbers are Bloomberg's, other than our numbers, of course. And again, we're doing dramatically better in the GL2 than in any of the alternatives. Although you could look at the 5 year for the GL2 and the 5 year for the corporates and say that's pretty much a push. Okay, so those are the two most requested slides over the last year. I think at this point, I have a little known secret that I'd like to share with you. My partner, Michael Giliberto, is the lead guitarist in a rock and roll band of some fame. And your question is, why do we care? And I said, well, because there is a cross between rock and roll and CRE, commercial real estate. And here to explain that mix is my partner, Michael Giliberto. Morning, Michael.
Good morning, John. Thanks. And good morning to everybody. One thing I wanted to do is to set the context. And the context is to start by looking at what's happened to commercial real estate values over time. And when I looked at that data and the GL2 data, it occurred to me that there were a lot of different eras, right? We had bull markets, we had Fed rate increases, we had Fed rate decreases, we had COVID, a lot of stuff going on. So I said, well, eras, and as John mentioned, being a rock and roll sort of person, when I think eras, I got to think of Taylor Swift and her recent Eras tour from, I think, 2023. So what we're going to present today, or at least what I'm going to be talking about, we're going to call the GL2 Eras tour. And that's there's John and me, as you can see, and we are on that tour now. So let's begin. When we break down the time period, so this is going to be looking at the GL2 period from literally its start on January 1st of 2010 up through now. Well, the first era and the long era, most of you are very familiar with this. Coming out of the GFC, we've really had an extended bull market run in commercial real estate. The data that we're looking at here comes from the NCREIF Odyssey Index. Now, it's not the fund index. These are the assets within the Odyssey funds, meaning the open-end diversified commingled funds. The reason for choosing this, which is a subset of the overall NCREIF index, is these asset values are marked to market every quarter. So again, to get it more also consistent with the timing and the mark to markets that are occurring in GL2, we felt that this subset was most applicable because we wanted that mark to market. So you can see 90%. Now, I'm not 100% sure I'm right about this, but I'm pretty sure I've read in the gossip things and the celebrity journalism that Taylor Swift is actually a pretty big real estate investor, primarily buying and selling very, very high-end homes. So I thought it'd be helpful to get some commentary from Taylor Swift on how she feels about these different eras in real estate, because as I think you all know, Taylor talks a lot about falling in love and falling out of love and heartache and heartbreak. So Taylor, what do you think about the bull market era? Whoops. Well, happy times, but I'm not hearing any music. Oh, well, there was supposed to be a musical clip there. I didn't hear it. Did anybody else? Guess not. Okay. Well, we'll just live then with the happy face era here. Let's go to the next era. And not surprisingly, that's COVID. Very short, not that the COVID pandemic period was short, but the real estate era was really only a couple of quarters when we saw overall a decline in the value of this particular price index. Now, to be sure, as everybody knows, there were very different results for different property types, and that's something we'll return to later. So we'll take the COVID dip period. Taylor, how did you feel about the COVID dip? Yeah, not good.
We get the years, we line up, we've been in a sunlit room. And if I'm
That's kind of sad,
alone
isn't it?
here, you
Let's move on.
there's two.
What happened come out of COVID? We had a massive monetary and fiscal policy stimulus. We'll just call it a booster shot. Markets felt pretty good. How did Taylor feel? Ah,
Shake, 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 shake,
nice stuff.
shake it out.
Then we have the Fed stepping in, taking away the proverbial punch bowl in early 2022. We'll call it the party's over era. And that index of prices fell by 19%. Kind of feels like a little bit of heartbreak to me. Let's get that final word from Taylor.
Oh, look what you made me do. Look what you made me do. Look what you just made me do. Look what you just
Thank
made
you,
me
Taylor. Julia, can you advance a slide for me? I'm frozen out. Thank you. So when we look at these eras, this is the GL2 performance over time. You can see the ups and downs in it. But let's break it down and look at the eras specifically. The bull market, 9% annualized return for GL2. And the capital value was up almost 1% annually during that period. Now, a lot of that was, if you look at the graph, way over on the left side, it was coming out of the GFC. And what we were seeing in GL2 at that point, deals that had made it through and not cratered in the GFC were getting marked back up as collateral values recovered, right? The start of that long bull market pulled collateral values up and gave a positive capital value return. The COVID dip was actually positive return still for GL2, but a negative capital value return as some assets were written down in value. The booster shot felt really good. Nice, positive, strong 8% annualized return, but a very small capital value return with not much going on in the collateral world other than collateral values improving, which is good for the underlying credit, but doesn't necessarily translate into higher values for loans that are carried at par, because you don't get the benefit of the collateral uptick unless you're the equity holder. And the party's over, though. It's a different story. The total returns have been lower in recent years, and a lot of that's being driven not by the income side, because if anything, income returns have become elevated post the Fed's rate move with higher interest rates in the marketplace, but it's been the deterioration in collateral value leading to a negative capital value return has been what's been holding back GL2 performance. But overall, as John mentioned, great performance over the long run, north of an 8% return. One of the things that we're often asked, and it may not make it in the top two, but I'd say another question that John and I get often is sort of how's the index grown and what's the size of the index? This is a particular way of looking at it. There's a lot of ways of looking at it. This measures the total funded principal, so the total amount of money that's been lent in GL2 to date, well, really to the end of 2024. The first quarter results aren't in here. So it's north of 60 billion. And that's just the money that's in the index. It's not all the money that's been committed. So there's a bunch more money when we talk about what's the value of the index. It's committed capital, but it's not yet been funded In addition, we're almost always in the process of bringing in new participants. And John and I kind of have a friendly wager on when we're going to hit 100 billion. And we think it could well be next time we do this event.
Yeah,
So we'll see.
I'm betting on that, Michael.
Yeah.
Soon.
So I'm going to go through as I usually do for those of you who've been with us before. Uh, I've got a lot of stuff. A lot of it's data. It's very geeky. I will try to explain it uh, and make it coherent and give you the takeaways. Obviously, if you have questions, either currently or in follow-up, we're delighted to respond to them. One thing we get asked about, and we think is interesting, is to look at what we call the market structure of the index. So this is kind of doing a dive below and saying, well, what does it look like? I'm having trouble advancing slides. There we go.
There we go.
One way of looking at it, we love these two-way classifications. So here's one in which we're looking at the nature of the investment, mezz debt, leveraged whole loans, B notes, and also at the same time saying, well, how do those divide up into the types of real estate strategies that the borrowers are pursuing, which we divide stabilized, bridge transitional, value added, and then this ugly not categorized category where we haven't been able to pin you folks down on what's going on with the real estate. So we're going to keep coming at you on that. Don't be surprised if you get phone calls or requests from us out there. This is all loans. So that whole $60 billion funded. This is what it looks like. And what do we see here? A couple of quick takeaways. The stabilized, it tends to be mezzanine tends to be focused and stabilized, not exclusively, as you can see from the numbers, but a lot of stabilized in the mezz. In the leveraged whole loans, no surprise here, I think, to anybody, bridge transitional is where a lot of the capital for leveraged whole loans has been going in terms of the real estate strategy. Again, not to say it doesn't pursue other strategies, but that's the focal point. And then senior whole loans tend to be, again, they're spread out, but a little bit tilted toward value added. And these are, of course, the stretch seniors, high LTV, and a fair number of these tend to be construction deals. So this is the overall index throughout its history. And if we look at just a snapshot as of year end 2024, we see basically the same kind of pattern in it. Well, another way to break out this market structure is, again, we're going to keep the real estate strategy, so stabilized, bridge transitional, value added, but look at not the loan type, but the source of the capital. So what type of investor vehicle is it coming from? Open-end funds, closed-end funds, separate accounts. I think, again, no surprise here. The big takeaway is the open-end debt funds very much specializing in bridge transitional lending. You can see the other types tend to be a little bit more spread out across the characteristics. And then finally, again, no big change whether we're looking at the entire history of the index, the top chart, or just a snapshot as of year end 2024. So the really bottom line takeaway here is the index is very heterogeneous. There's a lot going on in it. And going back to John's point, most portfolios, most investment management firms tend to be more specialized. I don't think we've seen anybody who really has an investment portfolio that looks like the index. Hence the need for looking at custom benchmarks, something we are actively doing with a variety of clients already or participants, and happy to do with you if it makes sense for you. Let's turn to some of the research results. I always like to talk about realized IRRs. Now, remember, we had an 8.3% time-weighted total return on GL2 over its history. But if we just pull out the loans where we got a complete history of data, we get an average 9.1% IRR. What do I mean by this? Well, our data set, we had 436 loans within our database. for which we had the entire history from when the loan had its initial funding all the way through to the termination. It covers the entire history of GL2. We've had stuff being paid off all the way from 2010, literally every year through 2024. More than $20 billion, more than $22 billion of deals in there. And this does not exclude credit events. It includes loans with credit events, including realized losses. So we're not cooking the books here. And in fact, as we'll see, those credit losses are a very significant factor. So for every individual loan, we calculated its IRR. It's got a 9.1% average, but I actually found something interesting when we delved into the data a little bit more closely. There were a surprising number of loans that didn't even go 1 year. I was a little bit shocked by it. It's clearly far from a majority. It's under 10%. But we had literally 30 loans in that 436 loan database that had an average life of 8 months and generated 7.5% IRRs on average. Now, that's not an annualized IRR. That's just for the whatever period the loan was outstanding. So I think a more appropriate focal point is the loans that have been outstanding for more than 12 months. The bulk of more than 90% of what we have, 9.2, so not very different from the average. And the average life about 3 years.
Michael, can we take a minute for a question or two
Sure.
at this point? We've had a couple come in, but I think this one goes back. Are these real estate strategies dynamic or just at origination, which is what we did, I think, 1 or 2 slides ago?
Yeah, the strategies are at the time of origination. So certainly it's entirely possible that if somebody originated a loan as bridge transitional and everything went well with the asset and the loan was paid off, it may have moved to being a stabilized asset at that point, since that would have been the whole point of both the borrower's underlying strategy with the real estate and the lender's understanding and the risk profile they knew they were taking on making the loan. So they do not basically migrate. So something isn't bridge transitional at one point in its life and then becomes stabilized once the asset is stabilized. We have to take them as what's the risk being taken and underwritten. And we think that's the appropriate way to handle it rather than tracking what's actually happening with the real estate per se.
Go ahead.
Okay, let's move on. I'm going to go through the next ones relatively quickly, and these are just showing some breakouts of that database. Here's by the loan types. You can see there's a range. Mezz debt's a little bit lower than leveraged whole loans. Senior, never leveraged, a little higher. But if you think back to that market structure we just looked at, this may make sense because the mezz debt tend to be a little bit tilted toward stabilized deals and the leveraged whole loans tilted toward bridge transitional, which ideally should be generating higher rates of return, all else equal. And the senior loans, we saw again, a bit of a tilt toward value added, we'd expect those to be generating higher returns. And indeed, if we go to the next slide, where we break it out by those strategies, we can see this lines up exactly with what one's intuition and finance theory would lead you to believe. Stabilize should have the lowest returns, again, all else equal, then bridge transitional, then value add.
Value add has some construction loans in it in general sense?
Oh, yes, absolutely got some
Okay.
construction and ground up
Yeah.
development in there. Another way to look at this is by property type. And of course, this is one everybody's wanted to see lately. These are in order, worst to best, with unknown being unfortunately the best. We'd love to find out what those are. Again, we'll be bugging you to remove these unknown and not categorized items. But I think nobody's surprised that office has suffered the most or has the lowest realized returns, lodging, then retail, and no surprise, industrial and multifamily have done much, much better. We also wanted to look at it by vintage year because this is something people often look at. But you can see here, there's really no clear-cut pattern here. And a point I'd like to make about this is it's here because people want to see it. My cautionary note would be because the GL2 is so heterogeneous, it's hard to know what this is telling you. It's not saying 2016 is necessarily a good vintage year and 2014 was a bad vintage year, let's say, just to take two that have about a 400 basis point spread, because it may very well be, maybe in 2014, what was being done was mostly stabilized mezz loans. By 2016, we were seeing much more growth in the open-end funds with their specialization or their tilt toward bridge transitional. So again, I wouldn't put the same weight on the vintage year pattern here that one might with, say, vintage years in private equity. Well, I mentioned that we included all the deals that had credit losses, and they're pretty rare. Of that full history, those 436 loans, only 3% of them had defaults where the principal didn't get repaid. But it causes a really big reduction in the IRR. If we exclude those 3% of the total number of loans, so basically a dozen or so loans in the total history, the other loans, the ones that were, call them, quote, successful, 10.4% IRR. How do we get to the 9.1 that I quoted before? Well, literally 135 basis points is lost on average due to the severity of these relatively infrequent events. So this tees us up to talk about credit losses. It's, I'd say, one of the hot topics these days. We certainly get a lot of inquiry about it. Some of you, again, who were with us last year may recall that we presented a credit loss history. I think it might have been the first time we showed it last year. And we're going to present now an update on that. Well, the background, though, is why did we spend time talking about those eras in real estate? Well, the really reason I wanted to tee that up to provide context was because the orange line here is that data. It's from that Odyssey price index data, but it's recast in a very particular way to look at drawdowns. So when the orange line is flat, it means that price index was either flat or going up. When the orange line is going down, it's picking up the downturns in the price index. So the first big dip is the GFC, mark-to-market decline. What happens after that big mark-to-market pullback in values? We see credit effects start rising. I'm using ACLI data here because it's very consistent. We go through, then as values start to recover, we get the rebound, credit events subside. The spike is COVID, and it's primarily restructured deals rather than delinquent or defaulted deals, with a lot of preemptive restructuring. And as you can see, the COVID dip, as we mentioned before, quite small in terms of the value drawdown. And then we get the current value drawdown. And you can see again, while we've actually apparently bottomed and maybe on the way back up in collateral values, the ever-present lag effect of both the incidence and the eventual resolution of credit events, it's still, we're in it now, and it's still going to be ahead of us for a little bit. That party's over era value decline, it's not happening just to the life insurance companies, which was the data on the prior slide. It's CMBS, it's GL2, and it's the banks. So it's been a systemic credit event. Everybody's gone up, obviously some more than others, largely reflecting different levels of risk. I will caution that these numbers are not all calculated the same way, so use these cautiously, but the story doesn't change. So here's our updated credit loss story. We added to what we presented last year, the 2024 events, and also backfilled data from new participants in the index. All the loans with realized losses are included. There's no cherry picking. So that would be loans where there was an interest forgiveness negotiated, like an interest deferral, but it did not all get paid back, even the amount that was supposed. So the amount that was supposed to have been paid, even with some forgiveness, did not get paid back. Outright defaults, where some of the principal or all of the principal didn't get paid back. Sales of non-performing loans, relatively in the minority. We don't see a lot of that, or haven't seen a lot of that to date in GL2, but there is a bit of it. And then restructures where there was a significant write-down in principal. Again, very rare, not too many of those in it. What we didn't include were any delinquent loans that were cured, interest forbearance or interest deferrals where everything got paid off, small restructurings where there was really no loss. And importantly, that last bullet point, there are loans in default. Not all of them will make it, not all of them will cure, but they're not yet realized losses. Now, they have been, in most cases, marked to market. So the effects of the deterioration in value is in the current GL2 and in what we've reported in GL2. It's just they've not yet been realized. The lenders haven't taken them off the books yet. So we're
Michael,
looking only at the realized losses. John?
yeah, it seems like I remember the sale of non-performing loans. That seemed like that was the purview of life insurance companies and pension funds, where they would try to sell them before they were in default, even though they were clearly, carrying losses, and they didn't want to quite realize it. So anyway, just a comment. Go ahead.
So I did want to do a bit of a level set here for everybody. A quick example to show the calculations. Again, I'm going to go through this pretty quickly, and then we'll move into the meat of it with the data results. But let's suppose we had a $100 loan funded at the beginning of January, 12% coupon, makes monthly interest payments, matures in 2 years. It's a 12.7% expected IRR. That's with the compounding. And unless a credit event occurs, the loan's going to be carried at par at 100 cents on the dollar. 3 scenarios. The loan pays off as expected. We get payments for 18 months. Then there's a credit event. Interest payments stop. Upon that event of no more interest payments, the loan is marked down in value. And then there's a final payoff, not of 75, but of 70 in the event year end 2024. And then we'll have another scenario. It's a little more draconian, in which not only do you not get the 75, you don't even get the 70, you get 0. So these are our scenarios. Scenario A is very straightforward. An index rate of return, it's 1% every month is what this loan would log in the index. Its IRR would be 12.7%. There's no loss severity. Very plain vanilla. Let's look at B. For 18 months, this would generate a 1% return in the index. In July 24, that's when it stops paying interest, and the value's written down from 100 to 75. It's a 25% negative return in the index. December 24, negative 6.7. That's the drop from 75 to 70. And its realized IRR is minus 7%. 30% loss severity. You got back 70, you wrote 100. Scenario C looks pretty similar, except the December 24 event is minus 100% return. You can't calculate a meaningful time-weighted return on that. The realized IRR is minus 80-something%, and the loss severity is 100%. I'm going to skip this, leave that in there. Let's look at the cumulative credit loss. Another way that we think it's important to look is, let's pretend that you owned the entire index and you really want to see over time, if I'm just constantly investing, how much money would I have lost? Well, over time, the default rate by loan count is 1.94%, and the average severity is about 60%. by invested dollars, the default rate's 175, severity's 57. So pretty similar kinds of numbers. The latter, the invested dollars one, is the one we really look at, but we're going to present both sets of statistics in the results here. And it's that last one that gives us the credit loss. So over time, if you had invested continuously in the entire GL2, you would have lost 1% of the principal you put up in investment due to credit losses. So that's a number to keep in mind as we now look at things in the more normal way, which is by event year. This is the kind of material we presented before, and this is what a lot of people look at currently. Year by year, what's the amount of credit loss? Again, I don't need to read the things here for you, but it's interesting to note, again, I'm showing at the very bottom here, that cumulative 1%, the annual average, 30 basis points. How do you tie those two together? Well, remember, our loans tend to have a life of about 3 years. So if you have about a 3-year life and you're exposed to 30 basis points a year, you get back up to about 100 basis points. So I think it's telling a pretty consistent story. It's just looking at it in a different way. You know, year by year, what do you stand to lose? And of course, there's a pattern here that's related to all those eras that we looked at. Now, another way to look at it is by vintage year. I don't believe we presented this last year, so this is new.
I did not.
And just another way to look at it, for the reasons I mentioned before, I'm not sure we should spend a ton of time exploring the vintage years effect, although you can see here very clearly, like 2020, the COVID vintage year, did have an uptick in credit loss. Probably not a surprise there. And the overall average here is pretty high. That's skewed a little bit by, if you look at 2014, you'll see a very large credit loss. Well, the index was relatively smaller. Again, if you went back to that slide of funded principal, there was a couple of big losses on a relatively smaller base. Now, we also want to look at this by property type. We said that there's a lot of dispersion. Industrial actually did not get hurt by COVID, right? Industrial was, if anything, boosted by COVID. Big uptick in industrial values. They've settled back some since their peak, but a big uptick. So let's take industrial off the table. We look at our other sectors, very different stories. Lodging, which is the orange line, a little hard to see, very abrupt dip in value in COVID, no surprise. Multifamily, big rise in value. Yes, it's settled back and come down, but it's still basically on par with where it started to up slightly rather than down. Office, again, everybody knows the story there, kind of was cruising along and then it got hit with a combination of the return to office issues and then the interest rate rises from the Fed. So very different stories in that overall index about what's happening at the property sector level. And not at all surprising to see that office and lodging are the big losers. And indeed, retail matches office in terms of credit loss, but retail's a very small chunk by weight within GL2. So it's really losses in office and lodging that have driven the overall losses in GL2. Industrial actually has had 0 losses in the entire history of GL2.
That's amazing.
Yeah.
Absolutely amazing.
So let's move on to first quarter 25. As John mentioned, the results have been released to participants, but I wanted to take a very quick, it's not really a report card, but kind of the good and the bad. It was a 1.18% total return. One of the bad news things is, as I mentioned, we've had this negative capital value return as part of that party's over era. And first quarter 25, unfortunately, marked the 10th consecutive quarter which we've registered a decline in capital value. So it's basically saying as collateral values have fallen, loans that were on the edge where the collateral value is now eroded, that's starting to show up in the marks. But the good news is 58 consecutive quarters of positive total returns. We've literally only had one quarter of a negative total return. That was way back in the very early history of GL1. I think it, or GL2. I think it actually may have been in the very first year. Performing loan values were actually up slightly. This was driven by the fixed rate loans, which are about 15% of GL2, having a positive mark to market for the most part due to US Treasury yields declining. And we saw the same effect in GL1. You may not recall the exact number, but it was like a 3.2% total return for GL1 in first quarter. And a ton of that was a favorable mark to market driven by a pretty substantial drop in intermediate long-term Treasury yields. But at the same time, we have a lot of performing loans. The rate of non-performing loans continued to increase. So these are loans that are either delinquent or actually in default. The rate went up, this is by the dollar amount, went up from 2.6 to 3%. So remember I mentioned before that there are still issues. The credit mess is still stuff we need to be working out. It's not going to go away right away just because values have started to turn around. So the NPL rate is up. And while performing loan values have been stable to slightly up, we are seeing continual write-downs in the non-performing loans. And this reflects both collateral issues and some mix issues. But I wanted to end on a positive note. And the positive note is we saw a positive net capital flow into GL2 type loans in the first quarter. And this was roughly a flat number in 2024. The net capital flow, just to be clear, this is the new money put in, funded into loans, minus the principal repaid on existing seasoned loans. So it was basically flat in 2024. And a nice uptick. The 1.6% is measured relative to the beginning of year capital. So round numbers, 20 something billion. So we're looking at hundreds of $400 million round number of positive capital flow, more fundings than repayment in this. So I take that as a positive sign, and I like to end on a positive note. And I see we may have some more questions, and I think
Michael, we have
a little bit of time, John. So
we have very little time, but we have a few. So I guess somebody picked up on the fact that we only took the top two slides, but he said, "What's the third?" And it's a thought on whether we're interested or whether we will freeze the index. This comes up all the time. NCREIF is frozen. What are we thinking about? Michael, you want to chat?
Yeah, it's a good question. You know, we think that we know it can be annoying or beyond annoying to people to see the numbers changing. You know, and especially saying, "Hey, I'm looking at this. I've got a benchmark number. I've looked at it. Now you just revise the history." So that's the downside, and certainly a very practical and understandable issue. But the upside and the perspective we adopted along with the initial group of participants was to the extent we can backfill significant amounts of historical data, we think that makes the index more robust and makes it actually ultimately a better benchmark, because then there's more data on mezz debt, there's more data on loans coming from open-end commingled funds. There's more data coming from separate accounts. So we've opted to not freeze the index currently. And to put that in the context of NCREIF, for those who are familiar with it, the NCREIF index was first published in 1982. It had data, its inception date for its data was 1978. So only had about 4 years of data, 4 or 5 years of data initially. It was not frozen until 2003.
Whoa.
So it went unfrozen for 20 years before it was finally frozen. I don't think we're going to necessarily, I'm not saying we're going to go 20 years, but we're going to be data driven, to use the cliche. And importantly, we continue to get significant additional participants in the index. I don't want to overstate it, but I don't think I'd be far off the mark to say we may very well have in-house $10 billion of activity that's not yet in the index that represents historical data from participants coming in. And
I
that,
think
yeah, we just wouldn't want to not include that data.
I think one of the things that comes up all the time is, why did you start in 2010? And the answer was, well, the GFC was over. We would like to be able to go back through the GFC to 2004, 5, or 6 and say, look, this is what happened in this downturn. And we have a significant amount of data, but as of now, we would like more data before we publish that. So we're always interested in going back, and if you're bringing us additional data and you're a member of the GL2, that's great. Michael, going back to your errors tour issue from the audience, did either one of you go to a Taylor Swift concert? Question mark. I'll ask you first.
The answer is no. They were. I appreciate Taylor Swift as an artist, but I'm kind of a blues rock guy. So Eric Clapton, the answer would be yes. Taylor Swift, I'll
So
pass.
for me, the answer is no, but I am going to see Alison Krauss along with Union Station and Jerry Douglas when they come to our new open air River Stadium in July. So if you're into bluegrass and you want to go see Alison Krauss, let me know. It's the end of August. Michael, we have a bunch more questions, but we don't have a bunch more time. So I think what we ought to say is thank you to all of you who attended. We are sorry about last week. We had an issue that came up and we just had to move it slightly.
It was me.
No, no, we're not blaming it on anybody. But we are delighted to have all the questions. We had dramatically more questions this morning. If you send us a question, we will make every effort to respond. If for some reason, I'm not sure why you would do this, but you sent us a question and it was marked anonymous, it's going to be hard for us to respond to the anonymous. But if we know who you are, we'll answer them anonymously. We'll make every effort. So thank you very much for attending. Next year's our 10th year. A couple reminders. The conference has been recorded. So if you'd like it, or your teammates would like it, Julie granted that the firm can make it available. We also send out a Zoom survey. So again, if you'd like to respond, that would be helpful, because we did certain things this year that we didn't or did do last year, and that was because in many cases you asked. We continue to welcome new data, new participation from both investors, investment managers, consultants, whomever. So if you want to join with us, we'd love to hear from you. Thanks to all. Thank you, Michael. We enjoyed it. Call us if we can help you. Look forward to it.